that the video was coming through correctly. All right. Well, of course, we're looking at here is just a 14-day free trial to PowerOptions. Those of you who are just getting started, I encourage you to take advantage of the 4 steps that are available for the coaching sessions, free webinars, flash tutorials, and quick start guide. Remember, the coaching session is not a sales call. It's just a 35 to 45-minute phone conversation with myself or Ernie, just like we're doing today. We'll answer your questions and show you the tools. Okay, so let's dive right in. This is Jay, correct? Jay sent me an email about 4:20 this afternoon, and he followed up here. I've got it already planned out. But Jay says he has a question regarding a position that he has on with Canopy, stock that Sam traded a few months ago, CGC, of course. Now, Jay is long 104 shares. 4 shares are a result of a buyout. Okay, we're just going to ignore those 4 shares for now. You have a cost basis on CGC of $22. You sold a November 1635 call for $12.80, roughly $12.79.3. Earnings come out on the 14th. Would you recommend any other management on this position? I would like to take the cap off my upside. Okay, so there's 2 obvious choices of what you can do to answer your question, Jay. I don't know if either one of them is exactly what you're looking for. But here's what we did. First thing I did, of course, is I went to the portfolio tools and I went into select strategy, clicked on covered call so I could enter it as a dual position, which is essentially what you have right now. And we entered the CGC position you have. Ignoring the other 4 shares, let's just leave that upside open. So you collected $12.79 on the stock position. You can currently buy this call back for $4.65. Not currently because the market is closed, I understand, but you can buy it back for about $4.65. First things first, let's go from the portfolio to the profit and loss chart on the position. Normally when I'm in the portfolio during these discussions, let me go back one, we would talk about rollout opportunities using the position analysis tool. And that's a fantastic tool if you're planning on rolling this as a covered call. You're not. You're taking a covered call position that you generated a large amount of premium on. And we're looking for a way to head into earnings with unlimited upside. Okay, well the first choice, Jay, is obvious. It might not be something that you want to do in this situation. But in that case, the obvious one is to just buy to close the call. Based on your numbers, you sold it at $12.60. You can buy it back now, midpoint of about $4.65, $4.50 bid, $4.80 ask, with the stock at around $38.50. Was it $38.50? I'm sorry. $38.97, okay. So buy it back. What is that going to leave you with? It's going to leave you a long stock position with a cost basis of $13.86. Okay, you had it at 22. You're going to keep $9 of the premium there. And I hope I have this right. In your email and on your question, you said $12.70. So I hope you didn't mean $1.27, that you meant $12.70, because this puts you in a great position with a break even of $13.86, your new cost basis, on a stock trading at $38.97. Your upside is open. Downside is not addressed yet. Okay, so buying it back, you keep about $8 of premium, cuts your cost basis down to $13.86. So you're just essentially long 100 shares of stock, well, 104 shares of stock at $13.86. Actually, if I factor in the other 4, it'd probably be around $14 for the cost basis. Going into earnings. Now, what I would consider at this time, what I showed in a webinar earlier this week, now you have the cost basis down, I might go into the Married Put tab and go into the Insurance tool. And inside the Insurance tool, let's say we buy it back for $4.65. I don't know what it's going to be on Monday. I'm just going to go over this as a review here. So we'll put in CGC, your new cost basis of $13.86 on a stock trading at $38.97. And I could go to November or December, but I might just go to November in this case. No, I won't. I'm going to go to December. Okay, you have an unrealized gain after buying to close your existing call of $25.11 from $13.86 here. 181% profit. You can lock in 123% by purchasing a December 7th 36 put for about $225. What does that do? That increases your cost basis to $16.11, but you're guaranteed to get 36 back. Is it expensive? Not really. If the stock's at 39, this 36 puts at about midpoint of 225. That's below intrinsic. That is very strange. Wide bid-ask spread. We're going to have to take a look at the bid-ask spread to get a more realistic point here. But in any case, by closing the call, you get a cost basis of $13.86. Our insurance tool will show you puts you can buy to lock in most of your unrealized profits, specifically heading into earnings. Let's look at the profit and loss chart of this structure. And while I'm here, I am going to change it a little bit because I think that midpoint is not realistic. It looks like it's below intrinsic. What happened to the stock? Am I on the right stock? I'm sorry, 38.97. 36. Oh, it's out of the money. I apologize. I'm thinking reverse. I'm thinking it's the call that should be priced at least. I'm sorry, got myself backwards. This looks good. That is accurate. $225. So you pay some money, buy this put at $225. Even if the stock collapses to 24, you're guaranteed 123% profit. If it gaps up, you lose that $225, but you still got unlimited upside profit potential. Your cost basis is now $16.11. Why? Because you made $8 on the call by buying it back. You took some of that and bought a put to protect the downside. I don't even know if I would mess with this further. What have you done? You've guaranteed 120% downside profit, even if the stock collapses at earnings. You still have unlimited upside if the stock continues to move. It's a shorter term December put, and if the stock goes up, you might lose that $225. But remember, you just profited about $8 on the short call. This is to protect you in the worst case scenario and leave your upside open. On the webinar on Wednesday, let's say I did this move. On the webinar on Wednesday, I showed a different move where you could sell a call and then buy a higher strike call, do a bear call spread in the context of owning the stock. And that would generate premium and then leave your upside open. But for what you asked regarding what other management can you do right now to leave the upside open, what was missing from that is addressing the downside in case this drops 30%. True, you have a cost basis of $13.89, but you've just profited $8 on the call that you sold. What's the harm in taking about a third of that and buying a put to guarantee that going through earnings, the worst you can do is make 123% profit on your investment and still have unlimited upside? Why mess around with it by trying to sell another call and buying another call to see how that works? But you know what? We're here. This is my job. I love it, and I want to show you everything. So buy to close your call. Make $8 of profit. Take some of that to buy a put. Now you want to generate some premium. Let's give ourselves a little bit of breath. We can go closer term or we can stay around December 7th. Okay, we could go to the 16th. Let's do that. Keep this put that we have. Let's go to November 16th and let's sell a 40 call at 175. It's going to cut down about 70% of the ask price of the put you just bought. But I'm going to keep it simple here. I want to go less than half. So I'm going to go to the 43 call at 80 to 95. Okay, so it's about half of the premium that we collected. Sell the 40, buy the 43. You're doing a bear call spread, but in the context of owning the stock, it leaves the upside open because either the call or the stock is still going to grow. Now you've guaranteed a profit of 136, but notice here, if it gaps up to just 42 or 43, you're not doing as well as what you just would have had with the put in place. So let's look at these numbers while we're here. On November 7th, mind you, I'm sorry, my apologies, November 16th, that's what the expiration is looking at now, not December. But if the stock's trading at 40, it's 26.45, right? This is with the stock plus that bear call spread. At 41, it's at 26.15, lose about 30 cents there. And going up at 26.05 at 42, okay, so we lose about 10 cents. 25.85 at 43, the call that you bought. And then it continues upward. It still is an infinite upside, and you've locked in 136% gain on the position. Okay? All right. That is something you do. What did it do? You gained about another 90 cents. You took about, well, a little bit more than a third of the premium that you paid for the put off by doing that bear call spread, what we call income method number 6 in the radioactive trading technique. It is a bear call spread. We're just doing the numbers there. Remember the numbers I just gave you, though. And I'll repeat them. So with that original position on November 16th at expiration, I know earnings are the 14th, but let's go to the red line here. The profit at 40 is 25.64. It's just below what you'd have with the bear call spread and this put added. I go up to 44, and the profit is 28.78. It is $300 more than if the stock was trading at 44 with this put and the bear call spread. Because of that little bubble there between 40 and 43, we gave some back. If it goes up to 48, 49, or 50, you'll be further ahead with this. In either situation, even if the stock collapses, remember you're making 123% guaranteed and 137% guaranteed. That being said, let's say the stock dropped down to $18 per share, had a disastrous fall because of the earnings. Does this mean you have to close out at 36 and take your 123 profit? No. You pay $225 for this put. On November 14th or 15th after earnings, Jay, if the stock is trading at 18, what's this put going to be worth? It's going to be worth $18. Maybe even some time value, but not likely because it's so deep in the money. Instead of exercising this and getting out of the position, you could sell to close this put for the $18 intrinsic value. Your cost basis would have gone up, of course, by the two. It's already at $16.11. You get another $18 back from this value. You essentially now still have 104 shares of stock at almost a zero cost basis that are trading at 18. Roughly the same profit you would have if you exercised it. But you could continue the trade. Buying the put is not like a call. Buying a put is not like selling a call. You didn't enter into an obligation in this case. You bought the right to get out at 36. You don't have to get out at 36. If it does have that disastrous fall, you can sell to close the put. You're still in the stock with almost a zero cost basis or less. Okay, so from what we reviewed on Thursday, when we talked about locking in gains and smile through earnings, this one here, buy to close the call because you've got an $8 profit. Take some of that profit to buy a cheap put out of the money put, 36 put. It doesn't have to be that one. Use the insurance tool, and you can even toggle through expirations to see which one best matches your goals. I could go to November. Absolutely. I could look at the different November series. For the 16th, locking in more profit, but at shorter term, and then add the bear call. That's a possibility as well. But I want you to decide. I'm just using this as an example. I got $8 of profit, by the way. I did. Sorry. You got $8 of profit on the position from that call. This is $225. What would happen if you bought 2 December 36 puts at $225? It cost you $450. You used up more than half of the profit that you made from the call. But what do you have now? Now you have a synthetic straddle. The stock's at 40, you make about $21.64, $400 or $500 less than what we saw before. But it's at 44, you're at $26.30, right about even with where we were. You still have an infinite upside. But instead of just locking in 123% profit, you can increase the profit in both directions. Nothing wrong with locking in 123% profit. We should all be so lucky. You're in a fabulous position. The worst case scenario with this is if the stock's trading right at about $36 on December expiration, way after the earnings, your profit's only 96%. So that would be locking in your gains and smiling through earnings with the cost basis you have. Are there any other options? Of course. So what did we just review? We reviewed buying to close your $22 cost basis on the stock, sold that call for about $12.70, buying it back for $4.65 cuts your cost basis down to $13.86. Buying one December 36 put locked you into 123% guaranteed profit, unlimited upside, exactly what your question asked. But I added some flair to it. Rather than leaving the downside open, we're taking a fourth of the profit you made to buy a put to guarantee we couldn't lose more. You take half of that and buy two puts, you've got a synthetic straddle going into earnings. We did show the bear call spread on top of that other structure that you already had. But is that better? Let's go back to it real quick. I'm going to save it here. We're going to do that bear call I did for November 16th once more. It was the 40.43, remember. About 176, 177 for the 40, paying about 89 cents there, 88 cents I think it was for the 43. Why did I choose the 43? Because I wanted half. Okay? I didn't want to go more than half, and it's right at about half. Okay? So that was this profit and loss. Now, one thing you could do to leave your upside open where you don't have to buy the put to address the downside is not something I would recommend. But the same thing that we were just looking at, you could kind of do here. You don't have the realized profit yet of that $800 from buying to close the call. But with the stock up at this price, what if now I simply just bought the 40 call for $1.80? What would that do to our position? So we're just going to buy one. That's going to be a little bit more than $1.80. $1.85 for the November 16th. If the they report on the 14th, as you mentioned, that's simple. You just added a little bit of cost basis into the position. Total cost is now $11.06. We didn't buy back the call for the 400, so we still have a lower cost basis on this position because the $12.79 you collected. Simply, you've got unlimited upside with a break even of $11.06. I'm not expecting CGC to go down to 10 or 8 or $9. Buying the put just locks in the profit, because if it falls to 20, you're looking at $894. I like to focus on buying the put if I have this much gain, so even if there is a 10, 15, 20% drop, I still have 75 to 80% of the expected profit at that time, maybe more, and I left my upside open. So this is another alternative. Now again, let's look at this alternative. What happens if the stock's at 40? Your profit is at $23.94. Okay, that's lower than just buying back the call and buying the put. Remember, that was at $26.45 if the stock was trading at $40. Now at 41, 42, 43 though, at 45, we're looking at $28.94. That's even with buying the put and doing the bear call spread with the 40-43 I showed as an example. You'd want to work the numbers, and it's even with that, but it's higher than just buying the put outright. Or do I have that reversed? I'm sorry. It's even with just buying the put. It's not as high as buying the put doing income method number 6, because we lose that 3 points in between. We lose that extra $300 in between, and then it still has the upside, okay? So what are we talking about here? Oh, sorry. Up to you. Either way, you've got the 35 calls. So option 1, do nothing, doesn't satisfy your needs. Okay, so that doesn't satisfy your needs going into this. We have a covered call with a large unrealized profit on the call. We want to get further upside. Number 2, buy an OTM call to leave the upside open. This is what we're looking at here. You still have a cost basis of only $11.06, and the upside is open. Downside's not protected. 3, we could do it this way. Buy the OTM call to leave the upside open, and then take that other $2, so this was $185, take another $225 to buy the put. Similar structure, but a little bit different. Okay, I'm going to leave that there, but real quick, I know it's a little bit confusing. I wanted to go out past earnings here, But what if I bought that 36 put after buying this out of the money call? Okay, so we just buy one. So there's number 3. At 40, it's a profit of 23.34, the lowest of the 3 combinations. Okay, and then it goes higher and higher, and at 42, 43, 44, where are we at? 26.48. About even, but there's give and take because you bought the extra call and you bought the put. So okay, you gave a little bit more, but you've locked in what? 167% of the unrealized profit. Your cost basis is back up to 13.43, but you don't care because you bought that 36 put. You can still continue further. And then Sam, of course, mentions you could even do the look at the expiration on November 16th, or you could just buy a straddle straight out at 450. Yeah, I think I would just use the one put to create the synthetic, or buy 2 puts with the long shares to create the synthetic, not do a straddle on top of the stock. Although it would look okay, you're right, it would protect the downside, but you could still lose the entire amount on the call because one would go to 0. Okay, so do nothing. Just buy an out-of-the-money call. Buy the out-of-the-money call, and then you could buy an out-of-the-money put. Increases the cost basis. And then, of course, we talked about the fourth one. Number 4 is just buy to close your call, take the $800 profit, and then buy an OTM put. As Sam said, either for November 16th. Either for any expiration, but that's why you'd use the insurance tool to see which one it is. But buy the OTM put to lock in large amount of profit, so you have that just married put structure that has infinite upside, guaranteed profit of 124, 125, 130, depending on the strike you select and the price you pay. That's what I think your options are. One out of the money call leaves the upside open. Out of the money call and out of the money put leaves the upside open, and you can still profit to the downside. Doesn't mean you have to exit it if it collapses. Not at all. You could sell to close the put, the calls expire, you're still in the stock at a lower target price, and then you can evaluate where you want to go from there. Buy to close your existing call, take that $800 of profit, use 1/4 of it, $2, $2.15, whatever, to buy an out-of-the-money put. You're into earnings with a guaranteed profit of 120, 130, 140% and unlimited upside. It's hard to gauge which one is best because they are all fantastic in my opinion. I can't really give you an answer anyway. I can't tell you what to trade, Jay, but those, in my opinion, are some of your options that you have available. Sam says CGC will have a big move. We just don't, he doesn't say this. He says CGC will have a great move. I just don't know which direction it's going to go. Yeah, and again, that other one I forgot to mention, of course, is we could look at it fresh. Buying to close the call, that 490, 485 puts you, the price has changed since the last update, but yes, you'd still have a cost basis of 1411. And then I could stay at November 16th and just say, you know what, let me just go right at the money here, maybe even the 38. How about that at 160, 175, and let me buy 2. How's that going to look for us? Guaranteed profit of 117%, unlimited upside here, and to the downside. If you're expecting a big move like Sam mentioned, I think this is the way to go. Sure, having just the put and the stock in place guaranteed you that about 124% profit, but if you're okay with this mark, then why not have a little bit extra in both directions? You're still locking in a great profit. Not much you can do to go wrong with this following those ideas I suggested. We don't want to sell another call and turn it into a bearish position hoping for a downturn, of course. But those, I think, are your options. I'd like to see the put be added to that, Jay, just so that you can have at least guaranteed profit to the downside with some of the profit that you took here. You do it double, you can profit more in both directions, and that just looks great. Okay. Oh, yeah, and Sam even mentioned that if I went out to December, of course, I went a little further to have a week or two after. That's why I went to December 7th, too. Sam's mentioning this on the offshoot as well, Jay. This is going to happen so quick that whatever happens to the stock, if it gaps up, that's great for you, too. but these puts will essentially go to zero. They're going to lose all implied volatility. If you go out to December 7th after the 14th and after the 16th, as the stock fluctuates in price, you still may be able to have some time value, some time premium on those puts. You could make adjustments to them, roll them as well. Sometimes there's a benefit with going a little bit past the earnings to continue management of the trade. Sam had mentioned you got the stock already, so just buy puts for protection, 215 at the 38 strike, and he meant further out. Sam just mentions, of course, I had mentioned at the beginning that Sam had traded CGC for a while, and I believe this was one of the two, it was Tilray, I think, and maybe this one, that a few weeks ago he joined us from Australia and said that the profits he made from those options paid for the trip. But Sam is out of CGC, but he's saying to us all, letting everyone know he thinks he's going to get back into it as probably a straddle or some other position going into earnings this week. Oh, I missed it earlier. Sam did say he had 32 CGC. He did not say he had 32 calls with CGC. He didn't do anything, and it went up $10,000 and was at $14,000 at one point as well. Okay, so there's you go. Those are my ideas, Jay. Those are the concepts we sort of reviewed Thursday doing the webinar, and yeah, the bid-ask spread is usually wide. I'd mentioned that. I'm just going through some of Sam's comments. They have been wide, but these look a little bit tame because, as you saw, Jay had mentioned that he had a cost basis of $22 on this stock. And he had sold this November 35 call at one point for $12. That might have been when it was way up here in the 40s or 50s. He picked a right time, or maybe even here at 45. He picked a right time, and it's been declining. So you've got that $8 profit on that call, and that's fantastic. Very fantastic for the position. It puts you in a great place to take that $800 off the table, Jay, and be able to finance the put purchases, one or two, to either have that no risk, bulletproof married put going into earnings with over 100% profit, or that straddle where you can go in either direction as well. All right, Mark and I had a discussion the other week about strategies. Mark said he has a pleasant week this week, closing out 3-week-old vertical call spreads on VXX. Good. Now flat, probably going married put collar out until I have a point of view on the market. That's about where I am too. I had an email back and forth with Sam earlier. He had actually asked me, he had mentioned that he had been doing well on Apple. He had been trading it with a couple of puts and a couple of calls, Facebook as well. And I forget it, but you mentioned another stock, and Sam kind of commented in the email, and he said, what are you looking at to buy today? Well, I haven't been looking at anything shorter term. The 3 positions that I've been looking at as a collar or as a married put are the ones that come up in here. Cadence has been looking good. Tractor Supply, it's 97, but it's been looking pretty good. PayPal was looking really good until today. Planet Fitness is one that also is looking good to me. This isn't a recommendation or suggestion. If I was opening I'm telling you, if I opened a married put or a collar only, no other strategy, longer term, 3, 4, 5 months out, planning on the position. These are some of the ones I was looking at. Planet Fitness isn't a great one for options because last time I checked, they only offered standard expiration and only 5-point strike differences on a $45, $46 stock. You don't have different ways to create spreads or 2-point spreads or 3-point spreads because it's not available. That is a longer-term play in my opinion. Mark, to comment on Mark's comment, but PayPal, of course, does have the weeklies, I believe, and does have different strikes. So depending on the movements, looked really, really good. I was in this for about a week, not as a married put, but as a different position, and it did really well for me. And then today I gave back about half of the profits I made. That's okay. Still got out with about a 60% profit. It was much higher before, got greedy, didn't close it, because the trend still looks right to me. The technicals still look right to me, but it had that pullback today, gave some back, just got out of it. I didn't bother trying to add a put to catch the downside or anything. I just got out with the profit I wanted for that part of my portfolio, small part of my portfolio, very small. But usually from the married put list is where I get my ideas. And I'm sorry, let me go to Tractor Supply real quick. I've just liked how this has been looking. Yes, I probably missed an opportunity or two. Saw it here in November 1st or 2nd when it was at 92 or 93, and it's been going up. and it's had that nice recovery and that nice rebound. It hasn't kind of showed a Bollinger Band breakout, but it hasn't really stayed above the upper band, and that's okay. It's still pushing everything else upwards, so it looks pretty good chart-wise in that situation. And I know you didn't ask that, Mark, but from our conversation last week, if I was looking into getting something here, and as Sam had mentioned, there's a couple of things on this list I really like. If I'm doing a diagonal, I'm sort of looking for a little bit different chart pattern, but these are the ones I'd look for maybe buying calls, following a trend, buying a straddle going forward if it's not related to earnings, just a little bit longer term. All right. Rajiv makes a comment here. He says, he had a good week as well. He said, make one big mistake. Instead of creating a condor on ATVI by mistake, you sold an extra put, I guess, instead of a call. Okay, and what did ATVI do for us this week? Let's just take a look here. Anyway, so that's good, though. It's a little bit, oh, yeah, that's why. Okay, so if you had sold the call there, would have gotten that back down to zero, but selling extra put, I don't know, ATVI, and I traded that at 1.2, kind of like the stock. A little bit tough there with that decline, but might not be something bad. Everything looks negative now, I understand, but if you've got put the stock, if you didn't buy back the put, if you got put the stock, might be something that could be a longer term hold if this reverses. Because it has been relatively bullish in this area. It's been, I think I traded it was in the 57, 58 range, sort of where it is now after this decline. But that does look pretty good in that scenario. All right, let's see here. Okay, so we've gone through some comments here, and we've gone through some of this. Yeah, Sam had mentioned PayPal, SQ, and he was also in another one. PG, I'm sorry, that's the one. Okay, so I'm just reading this here, and I'm going to answer it for Michael. Okay, so I'm not going to read everything out, Michael, because you put some personal information there, and that's perfectly fine. Michael says, I am interested in a one-to-one 15-minute training session to answer a few questions. Do you offer a quick trading training calls? Well, yes. Anyone who's a trial member or subscriber to PowerOptions can schedule a free coaching session. So I can schedule a session right now for Monday at 10 a.m. Just ignore the phone number there. I'll go ahead and select a strategy discussion. Michael's question goes on to say that he wants to talk about my questions for trading concerns the iron, butterfly, and thinkorswim. In addition, once the trade is initiated, I would like to set up automatic stops so it can be initiate and forget, and a few other questions. 15 minutes should be plenty. Okay, so I'm scheduling the 10 a.m. Eastern time. Any trial member subscriber can do this, and I'm just going to say discussion on iron butterflies with TOS. I'm going to put an asterisk there because I'm going to come back to that comment. Trading, setting alerts, and what was your last part there? A few other questions. Okay. Strategy discussion, leave it there, and we'll just go ahead and say reserve now. So my coaching session is scheduled for 11/12, Monday at 10 a.m. Eastern Time. I'm going to receive a confirmation. This is for my webinar account, but there it is, your time. As I said that, I can't show you guys. I can take a screenshot, and I'll post it with the webinar. But it just came up and told me that a help session for William Adama was scheduled at 10 a.m. for 11/12/2018. Okay, so why did I just go through that whole process? The coaching session can be a 40 to 50-minute phone conversation. It can be 5 minutes, it could be 10 minutes, it could be 30 minutes, it could be 15 minutes. Whatever you need, Michael, is what we'll do. Why do we cap it at 40 to 50 minutes? Number one, we're busy. We like to give other people time to schedule sessions as well. Number two, through the 12, 15, 20 years we've been doing coaching sessions, Ernie for about 20, me for, about 15 or so, we found that if I spend 40 to 50 minutes with you, as we do on these Friday sessions, but if I spend that long with just you talking about a variety of things, in 3 to 4 days you're going to call me back and say, maybe even a day or two, you're going to call me back and say, we had a discussion the other day about collars, calendar spreads, diagonals, and iron butterflies. What was the thing you said about calendars? So we like to keep it easier. We like to keep it in line with what you want to do. Okay? And one thing I want to mention is that this is not a sales call. You should never be afraid to schedule the coaching session. Never be worried that I'm going to sit there and just say, oh, buy this, oh, do that, subscribe to this level, and that's it. No. I handle the coaching sessions exactly as I handle these Friday discussions. Jay asked me a question at the beginning. We spent almost 25 minutes, I believe, going over Jay's question. I never mentioned at one time that he could have the benefit of using the portfolio or those tools by subscribing or creating a free trial, or if he signed up for a yearly subscription or something along those lines, he'd get the benefit of this. It's my job to make sure that you see the power of the tools I'm using and the value of the education that Ernie and I offer, and that itself is the sales call. I'm not going to push anything on you. I'm going to guide you in the direction of I think what's going to work best for you, but it's not a sales call, and you should never fear scheduling a coaching session because I treat the coaching sessions exactly as you see on these Friday discussions. Okay? So now, that all being said, you sent your email, and I'm not going to repeat it online, Michael, but if you're currently not a trial member or subscriber to PowerOptions, no problem. I can still schedule a session or a time for you. I can still work with you at any time. You can send me an email, or you can call us up during market hours, excuse me. So if you just wanted to have a 10, 15-minute conversation, most of the time you can just call in during the trading day. Ernie, myself, Greg, or one of the other staff members will be available to help you. If you want to talk to me specifically, it's just better to schedule a time because, on Tuesdays and Wednesdays there are slots available, but I'm usually hosting webinars on Tuesday from 1 to about 2, from about 12 to 1:30 and 12 to 1:30 and 12 to 1:30 on Thursday. So you typically won't see me personally available from about 12 o'clock till about 3 o'clock. But Ernie will be available at some of those times. So you can schedule a time that matches your convenience. If it matches your convenience, Michael, I can leave this reserved right now for me. We can talk at 10 in the morning on Monday, 10:15, 10:30, because it's already blocked out for the webinar account as well. But one thing I will say about your question, and then we'll move on, is that you had mentioned about doing iron butterflies and thinkorswim. I know of the thinkorswim platform, and I've seen demonstrations of how it's used, but I'm not 100% familiar with it. Meaning if you're having entry problems on thinkorswim with a 4-leg or 3-leg spread, you may need to contact them because they're going to give you much better insight than I can onto their tools and as well. Okay, so that's what we want to consider with that scenario. Michael, I'll tell you what. I said as a trial member, you can sign up for a coaching session at any time. Michael did write back in as I was talking and said 10 o'clock is good. I don't have your phone number. Email me later this weekend or after the webinar. Send me your phone number. I'll call you at 10 a.m. on Monday. We'll have our 15 to 20-minute conversation. You don't have to sign up for a trial. It'll help if you sign up for a trial because I can show you how to use the portfolio tools, and that if I do set up an iron butterfly in the portfolio, I'm not going to use anything I think has earnings. Let me just use APA. I was in a discussion with a customer there, but let's just use APA. All right, so I'm going to structure my butterfly here. I'm going to go out to the 23rd, and I'm going to do we'll go 35, 37. How about that? This is not a recommendation or suggestion. I haven't looked at the full technicals on this. I personally don't trade iron butterflies in my personal account, although I have legged into them, meaning that I had a bull put spread, and as the stock moved, I sold a bear call spread pretty much at the same strike price. Okay, so what am I doing? I'm opening up butterfly with the 37 call and put and the 35 and 39 2 points apart for an even width spread. I'm just going to leave the prices as they are, Michael. All right, so now I have my iron butterfly into the position thank you. I'm sorry. I did do that backwards. I apologize. Let me edit this position in the sense of sorry, folks. Anyway, it's 37 put and the 35. Okay. Why did that not register right? What am I missing? I apologize. I'm looking at something. This should have come up as an iron butterfly anyway. Why is it not? I'm selling a 37 call and a 37 put, buying a 35 and buying a 39. It's like a butterfly. It's like a condor, but with the same strikes. Why is this? Because I chose the November 16th. I'm sorry. That's what I missed. I'm sorry, folks. I did not see that. I selected the wrong expiration. I need the 39. Yay. There's, okay, Michael, let's start over. There's my iron butterfly. And now what I want to do to set alerts on this position, what do I need to know? Well, first off, when I looked at the profit and loss chart, when I finally got it right, I'd want to know my upper and lower break even. I'd probably want to be notified of an alert on this position. Doesn't matter which leg I put it in, but if the stock moves more than, let's say, 2% away from the 37 strike put or 2% away from the 37 call, I might consider management. So if the stock price limit, let's say the lower limit drops down to 35.50, or it goes up to 38.50, $1.50 in either direction, I may want to consider making an adjustment to one of the short legs that's going in the money. Okay. If there's a percent changed in my favor or against my favor, I might want to be notified. If it suddenly goes up and hits, goes above the upper Bollinger Band or lower Bollinger Band, I might want to be notified of that as well. So those are some basic alerts that I might set. You might also set it based on premium. But yeah, sorry. So here in the portfolio, I would just set that. And now for our butterfly, I've got an upper and lower stop point or trigger point, alert point as well. Okay, so that's where I'd probably start off with that as far as it goes. But as far as entering it into TOS, I may not be given insight. But I'll keep it at 10 o'clock. Email me your phone number. I will call you at 10 in the morning Eastern Time, 10 in the morning Eastern Time on Monday. And we can go through that then. Okay, but yeah, you can track it here. I can use the alerts in the portfolio. If an alert's triggered, it'll highlight here. And as you probably saw, oh, this isn't a subscription account, but you can also, as a subscriber, select to have these alerts sent to you via email when they are triggered as well, so you know that you might want to take some management on that position. And I apologize if I fumbled through that for a moment. I just didn't realize I had selected two different expiration cycles. So now I've got our iron butterfly in, and we're going to track that. All right, let's see here. And we'll keep the coaching session open for you. And we'll just send that to me there. And there's that question. Okay. All right. Rajiv's first question. Bought 100 shares at 65.30 and sold at 67 by mistake instead of a call. Okay, this is going back, I'm sorry, to ATVI. You bought the 65 put, busy, thought you lost 230, realized it was a big mistake. How to repair it? Oh, okay. Well, think about it this way. You do have a stock that's down in price. Okay, so we're going back to Rajiv's position, my apologies, on ATVI. And we're looking at essentially owning shares of stock before this earnings drop at 65.30. And you sold the 67 put when the stock was trading higher. I'm sorry, November 16th. There we go. And you probably got reasonable premium of $2 or $3 somewhere in that range, okay? and bought, good, a 65 put for the same expiration. All right. Now, we'll just put 0.85. You thought you lost 230 in the collar and you checked, you realized a big mistake. How to repair this? Told cost that time was 65.30. Okay. So, okay, here's what we're looking at now. We're at a loss of $1,100 off an investment of $64.15. The good news is that you thought you were entering a collar by selling a 67 call, but you didn't. You sold a 67 put and bought a 65. Thankfully, I know it sounds strange, but thankfully you still have the 65 put in place. Essentially what we've done now is taken a $2 loss on this spread, but not really, because you did keep some premium. Okay, so on this portion it adds to the hurt. You're down about $10 on the stock, and whatever the extra $2 minus the 80 cents or 90 cents, so maybe down an extra $1.10. So we're down about $11. What I would simulate, of course, is closing this out. What would it cost me to just close out the 67 and the 65 put? So let's do that first. We're going to do the opposite transactions. I sold to open the 67 by mistake, but that's okay. So we're going to buy to close it. Apologies. And we're going to sell to close the 65. Now, right now, this is above $2. You'd get better than that. So it's because it's so deep in the money, you're right at the full loss of $2. This shows $2.08. It's never going to be more than the difference in the strike prices if you enter the closing correctly. So again, what am I left with now? A cost basis in this case of, let's say, $66.22. All right. So what am I going to start with? Well, I'm going to start with the basics. I'm going to go to the signature tools here. I'm going to go to stock repair. I don't think I'm going to find anything, but you know what? I am going to try. Cost per share, $66.22 on 100 shares. Goes out to May. The first repair that's available is in May. It lowers the break-even down to $59.84 by buying 155 call and selling 260s for a net credit of $1.55. It's very far out in time, though. That's what I would expect to see. Okay, stocks at 55. You know I don't like to do this that often, Rajiv, but that webinar that we hosted about 8 months ago, 9 months ago, and it was the third time we did it, of course, repair your broken stock position. If you bought another 100 shares at 55.01, yes, I know it's on a big declining stock, but if you buy another 100 shares at 55.01, you're going to have more cost basis into the position. You're going to have more money into the position, but you're going to lower your cost basis probably by 5 or 6 points. Okay, so let's put this cost basis at 61. Let's say it lowers it by 5 points, about a $10 difference, is a little bit more. But let's go ahead there. So we have a new cost basis of 61. Now I see December repairs where I just need the stock to go back to 57.91. You've doubled the money in. We'd have 200 shares here with a cost basis of 61 instead. And we get repairs available for December and some for January, where the break-even is just at 57.91 or 57.22. Now, I hate to say this, but this is what's discussed in that full webinar. Again, remember, you can go to powerop.com/webinars.asp, the free webinars page here. It's under Options Concepts. Yep, manage your broken position. I believe there's another one actually hidden in here somewhere. Let me take a look. No, okay. I thought there was another one here that was more recent. I might look for that one. But in any case, under the options concepts, manage your broken position. It'll walk through some of these ideas. At this point, I think that you may have to buy another 100 shares to get the cost basis down to find December or January repair positions, and that'll look fine. If you think the stock's going to continue to go down, I hate to say it, but you might just want to close the stock and buy puts. Okay, that's what I can answer there for you. It's tough because what does this do? Let me go back. The stock repair is a fantastic way to get back to break even faster. I put in buying an extra 100 shares to lower your cost basis to get a repair in December instead of May, which would be putting more money into the position. Doesn't give a great return, but your break even's 57.91 now, not 66. And the stock's at 55. That's the power of this sort of ratio call spread that can be built there. You get a little credit in, but then you get $3 back, and it puts you back at break even. Not a high return if it's above that. What doesn't the stock repair do? It doesn't address the downside. This is typically done if you think this was an overreaction and the stock's going to recover. Unfortunately, if it's down here, it's fell, and you don't have any prospects for it getting back to where it was, and you think it's going to continue to decline, you might just take the loss or buy 2 puts right now against the stock position to do that sort of straddle, but you'd still have a wide range to break even. It'd have to drop another 8 or 9 points for you to get close to break even at that point. Okay, sorry, Fernando's question now. I'm going to shift gears here. That's my thoughts on ATVI. I encourage you, again, as I mentioned, to go to the webinars page, go under Options Concepts, check out Manage Your Broken Position. And this link, powerop.com/webinars.asp, this is a public page. You don't need a trial. You don't need to be logged in right now to access all these webinars. You can do it at any time. It's a public page. Just go to powerop.com/webinars.asp. Okay, so for Fernando, he asks, by the way, hi Fernando, or ciao Fernando, I should say, which is the best way to close a married put structure? Roll the put on the front chain and let the put expire in the money so the stock is delivered, or simply close the put and sell the stock? Close the put and sell the stock. Okay, if you've made up your mind to exit a married put position, the RadioActive Trade stock plus put combination, and you still have I'm sorry, something's weird here. Okay, let me use it. This isn't going to be a profit. This is going to be a severe loss. Well, oh, let me use AMD. Perfect. AMD is pretty good. AMD we put in that we bought at 976 on a webinar back in April. I haven't done any adjustments to this position. It's not a real position in my account. It's for educational purposes only. The January 12 put was bought at 298. Okay, now in this case, it's not that severe. It's not that great. But look, I could sell to close it at 13 and sell to close the stock at 2103. My liquidation profit would be 66.2% because the stock's up 115. Just ignore those huge numbers, but let's take that. That's my liquidation, 66.2%. I've decided to get out of it now. It's only worth 13 cents. So is it worth it having the January put, I'm sorry, I needed the moneyness there, 843 or 66.2%. All right. Is it worth it now to, instead of selling to close this put at 13 cents and selling to close the stock at 2103, to try to manipulate that 13 cents, sell to close the January put for 13 cents, and buy to open a cheap November 17 put, let's say. Roll it in time and roll it up, or even just rolling it in time. Now, what happened? See, my worst case scenario is 435 if the stock falls. That's good. Okay, but I'm making 843 right now. The stock stays at this price on expiration next week. I'm only making 835. Why not just close it now and take 843? You're giving up a little bit when you roll in. Okay, even if you're rolling in time and you're rolling for a credit, it's not really improving the position because you still took a loss in what you originally paid for the put. I bought it at 298. It's now realized because I sold to close it at 13. And then I bought another one for 4. Cheap as that may be, what did that do? That added 4 back in and took away from the profit. Okay, better to just sell it and then sell the stock and you're done. If you've already admitted to get out, don't worry about using that income method to roll the put in and say, I'm just going to leave it alone, and if it stays below it, they'll exercise. This one's up. Let's take one that's down. And I had it. I saw it here. Let me clear out this put. This is my Penn Gaming position, by the way, that I was in for a month. I could have held it for another 5 days, but that's okay. Sorry, Penn National Gaming. You've heard me talk about this. Down 36.6% now. It was down 31% when I liquidated it, and I had a 10% profit, and I was long stock the entire time. I could have probably gotten out with a 15% profit if I held it. But for a month, 10% return on a stock that's down 30%, why not just get out and not worry about trying to milk it one direction or the other? I just closed it. Okay, so same situation here. Penn is a huge loss in this case. But I still have an April put, don't I? It's deep in the money. It's over 50% in the money, okay? But is there any value in it? A 35 put at midpoint. It's at $14. Okay, so it's 8 cents of time premium. This one's going to be a wash, but still, if there's any time premium left on the option you're selling and on the option that you're buying, which there will be, even though it's a shorter term, it's likely better just to sell this at 14 and then sell to close the stock at 20 or 21, okay? Not to mess around with rolling it in time. If the stock hasn't been doing what I want, Rajiv, and I'm at Fernando, and I'm at about a 5% or 6 or 7 or maybe even a 10% loss, and I've got an April or January put, but earnings are coming up on the 15th. Now that's a consideration to take some cost basis off, to move the put in, to go through earnings with a cheaper cost basis, and if there's a jump in the stock, I may get closer to break even or less of a loss. But if it's not based on earnings coming up, if it's not based on trying to reduce capital before that, then it's better just to liquidate if you think you're against that position. Okay. Okay, I'm just scrolling through here some of the other thoughts. All right, hold on one second. Okay, there we go. All right, give me 1 second, ladies and gentlemen. I'm going to scroll through here real quick. Sam, I'm going to do that for a moment. Okay. Okay, and Rajiv, going back to that, you had mentioned to wait to settle before you buy. Sam was throwing in some thoughts there. You didn't get filled on ATVI. He says, don't worry, Rajiv. In his opinion, ATVI will recover. It'll take some time to go up because of weak guidance. Users was down by 12 million. But it says that's another main point, but it might have to wait till the next quarter. So he's just offering some insight into what he's been looking at. So they're going to have to increase their number of users. Okay, there we go. Okay, so just going through some of that. Thank you, Mark. I did see that too. That's when I realized your comment, Mark, that it was not the same expiration. So, and Rajiv noticed it too. Now, last question from Rajiv, or the next question that came in. I believe it is the last question I see right now. Going to CRON, one of the other marijuana stocks, I believe Kronos, if I'm not mistaken. Whoop. CRON. Owned 100 shares at $8.20 and sold a week back around $9.30. Was waiting for the same price but realized everything earnings next week. Better enter using a married put or just wait for a result later. Looks bullish to me as per news in the media. Okay. So yeah, let's take a look at where we are now. It's at 8.55. You sold it at 9.30. It pulled back. Yeah, I mean, you might want to consider this as a married put position going into earnings with a cheap put. I might even just go out 28 days. If I bought stock now at 8.55, I don't know if I'd go with the 9 right now, but I'm going to try it. I'm really thinking about the out of the money one, but I don't know. I like this little in the money. That's still too high. All the 850, that would be too high of a risk. It'd be above 10%, 15% because of the price, because everyone knows earnings is coming up. So it's a little pricey there. Another thing that I could do in this situation is if you wanted to get back into it with earnings coming up, but you don't want to make, I'm sorry, didn't mean it like that, but you don't want to get caught which unfortunately you did by accident with the other position. You could go out a little bit. Let's stick with December 7th, and I could just do a standard collar maybe. Let's see if we sell the 9. Oh, these prices are bothersome. Sell the 9 and buy the 7. It's not going to be great. It's going to be a net credit of 33 cents, good enough for a 9.5%. Yeah, that's what I meant. Good enough for a 9.5% if assigned to the upside, or a 15% loss. See, that's tough to swallow. I don't know if I would do that because of the prices in this case. You could try to manipulate. So why would I do it as a collar in this case with earnings coming up? Because we don't know. Now, this shows me a loss of 123 or 15% if the stock falls below 7, right? But what is else in existence here? You already have a profit of 110 not being accounted for. So even if this fell and you took the full 123 loss, you're only down 13 cents. Why would I do this anyway? Why go into earnings with a collar? Because you're unsure, and if the stock gaps up, hey, let it get assigned and make another 9.5%. Just don't even try to roll the call. Just take assignment, take another 78 cents on top of the 110 that you already made from the previous stock transaction, and you're good. You're a little bit better. If it falls, you're still only at a 13% loss, and then you could decide to manage it from that point on or just close the position. But yeah, getting in without some kind of put protection going into earnings would be really risky. So I would say rather than, you could do a married put further out if you're expecting, but if it does fall 15, 20, 30%, you don't want to start that far below the hole. I might just do a standard collar and then sort of take it as a win or take it as a loss. And if it's a win, well, now I've got $1.88 of profit. I could buy the stock at the higher price knowing I've already got $1.88 locked in. You know, so I mean, this is sort of the new hot thing now with these types of stocks, Kronos, Tilray, CGC, the marijuana stocks. But again, we don't know what the market is. Well, we know what the market is expecting for their earnings, but have they realized it yet? Is it more of a longer-term play as a married put, Rajiv, as you mentioned? Rather than doing the collar, maybe doing something farther term, but it's overpriced right now because it's more volatile. It's really hard to get a single-digit risk with these types of stocks at this time because of the volatility. Although CGC did not look that bad, as Sam had mentioned, and we had mentioned when we were looking at that other position, the bid-ask spreads do not look that bad on CGC, even in the near term around the earnings cycles. That's quite interesting as well. All right, well, ladies and gentlemen, I don't see any other questions that have come in. So I'm just going to navigate back over here, and I just want to remind everyone, now this is where I do the sales call. If you like the tools that you saw today, we saw some of the search, but we didn't really go into the capabilities of the various criteria that you could change in 23 common strategies. But we did see what could be structured with the search tool when we went to look at the married puts, of course. We saw the portfolio tools for tracking and managing positions, setting alerts, how we could evaluate rollout opportunities. The system calculates for you. We did ours manually there with the custom spread tool from the portfolio with our numbers already in place. But you can take a 14-day free trial at any time if you want to test out these tools. Simply go to PowerOp.com, put in your first name, last name, and email address, and you can go ahead and start your trial. You have full access to the tools for 14 days. Now, the subscription level services after that start at $40 per month. The most popular service, of course, is the delayed service at $60 per month. The end-of-day service only updates the option and stock data at the close of business. So if you're looking for positions today, the numbers were based on Thursday's close. If you're doing anything like covered calls, if you're using any type of weekly options, spread positions, you need to be at least at the delayed service, but you could also upgrade to the real-time service at any time. Now, if you want some other education, remember, go to that webinars page, powerop.com/webinars.asp. You'll find webinars on the PowerOptions tools, various option strategies, management techniques of strategies, and much more, plus the options concepts section where we talk about Greeks, implied volatility, of course, special stock dividends, and more, and the webinar we looked at today, pointed Rajiv to, on managing a broken position to help you get back to break even faster if a mistake was made or something just unexpectedly went against you. And recently I have been posting all of the webinars I've been doing as public webinars, public videos on YouTube, so you can check us out on YouTube as well. Now, if you think of any questions later on, remember, send me an email to support@powerop.com or support@radioactivetrading.com. As we talked about with Michael, you can call me during market hours at 302-992-7971. And of course, trial members and subscribers schedule a coaching session. We just walked through that today with Michael. I'm going to talk to Michael at 10 o'clock. He's going to send me his phone number. We're going to talk at 10 a.m. on Monday morning for about 15 minutes. It'll be longer than that, I can guarantee it. Because once you get on the phone and you start asking questions and you realize the benefit of talking with myself or Ernie in a one-on-one session, you realize that you can ask more questions and we'll be there to answer them. But as I mentioned, it's not a sales call at all. We're going to strictly answer your questions. I'm going to help you out, Michael, as best as you can. I'm going to show you how I might use the tools to implement your needs. We'll walk through that on the phone as well. And the sales call really is the site itself. Once you see how powerful it is, how it can solve all your problems for finding new positions, tracking and managing positions, and of course, all the free education that we offer on a regular basis for different market conditions, market strategies, option strategies, and more. Ladies and gentlemen, thank you once again. Loved all the questions today. I think we had a good time. I had a good time. Hope you had a good time. Have a fantastic weekend. Have a relaxing weekend. We will see everyone soon. Where next week we'll announce, we'll post our other scheduled sessions coming up, scheduled webinars for next week as well. We'll also let you know via email. I will let you know when this webinar has been posted to the website, to YouTube as well. So take care, everyone. Have a great weekend. We'll see you soon. Good night.